Here's a common belief in infrastructure investing. Bigger assets should deliver better returns. The data says otherwise. A study of 187 infrastructure assets looked at asset size, ownership share, and 5-year returns. The goal was simple. Do larger deals or more control actually improve performance? As assets get bigger, ownership gets smaller. Smaller assets, so 76% ownership. Largest assets, now 42% ownership. That's expected. Large infrastructure requires more capital. But returns? They didn't increase. In fact, they slightly declined from smaller to larger assets. Ownership tells a similar story. There was no clear relationship between how much you own and how the asset performs. And surprisingly, full ownership showed the lowest average returns in the dataset. Where things get more interesting is in consistency. Larger assets showed less variability in returns, more predictable outcomes, but not necessarily better performance. The real takeaway is this: returns are driven by asset type, risk profile, sector exposure, and market conditions, not just size or control. So bigger doesn't mean better, and owning more doesn't mean outperforming. In infrastructure, performance isn't one-dimensional. It's driven by what you own, not just how big it is.